The June 2025 TIC data just dropped, and it's a red flag for the dollar. Foreigners are selling U.S. Treasuries, with official institutions like central banks selling off billions in government bonds, and big decreases seen in dollar deposits too. We'll also look at who exactly is buying our debt and why it actually matters for the potential erosion of the dollar's reserve status. Is this the start of a dollar crash or just continuation of existing dollar negative trends? So before we get into the data, and there is a lot of interesting data in this TIC report, we have to establish key context here, which is the U.S. runs a current account deficit, a large one, about $150 billion per month if you use the last BEA report that came out a couple months ago. What that means is that the U.S. must run a mirror image surplus in terms of capital and financial account. This refers to foreigners pouring dollars into financial assets in the U.S. They are mirror images of each other. Some have even argued the capital and financial account surplus, aka foreigners buying a bunch of U.S. assets, is actually what is causing the current account deficit, which is mainly comprised of the balance of trade. Here is that balance of trade. We can see that for the month of June, the balance of trade, or the trade deficit in this case, was $60 billion for the month of June. Now, this has seen a lot of volatility with tariffs and all of that front running, and then and so on. So we need to watch the next couple months, the next couple quarters, to see where this actually settles out. If you use the last current account print, the current account looks pretty awful. It's about 6% of GDP. But if you look at balance of trade, it is starting to correct. But we need to watch this the next 1 or 2 quarters to see how much this actually corrects. But again, about $60 billion for the month of June in terms of the trade deficit. What that means, remember, with the current account, an equal but opposite amount of capital must be flowing into financial assets in the U.S. Here, between the dotted yellow lines are what the S&P 500 did in red. We can see the S&P 500 showed pretty good strength in the month of June, and the dollar showed significant weakness, especially towards the end of June. Now let's take a look at the yield curve. So again, these dotted yellow lines represent the period of time we're going to look at. We can see the curve did not steepen. The curve remained basically flat for the month of June. And in general, yields were coming down. Remember, the value of the bond is inverse to the yield, so bonds were getting bid. The 30-year got a slight bid, the 10-year got a slight bid, and the belly of the curve seemed to get a bit more of a bid. So here's that 30-year yield on a daily candle chart. Again, yields were coming down. Bonds, in this case the 30, were getting bid. We can see the spread between the 30-year yield and the 2-year yield remained, again, about flat for the month of June, which is what we're going to be looking at. Here are a couple different 10-year government bond yields across the world. Here's the U.S. 10-year yield for perspective, 4.30. The European average, significantly lower at 2.89. And then Japan, while rising sharply over the past year or two, is still nowhere near the U.S. Yield. Now, remember that when we did our videos in April, when the dollar was dumping and equities were dumping and bond yields were spiking, we showed this interest rate differential chart and noted that it appeared, we didn't have the TIC data yet, but it appeared like foreigners were selling U.S. Treasuries en masse. Maybe even coordinated. And this was one of our first successful videos, actually, kind of right away. People seem to like it. So we'll revisit that just in the spirit of history of the channel. We will revisit this for the month of April and see whether those calls of Treasury selling by foreigners were correct. But what we noted during that time period was that the interest rate differential, or the spread between the U.S. government bond yield and the European government bond yield on average, that spread was diverging from the strength of the currency. Generally, this white line, interest rate differential, drives the strength of the currency. If you get a higher interest rate in the U.S., generally speaking, if you're European capital, you would want to buy the dollar and then buy treasuries. So this puts upward strength on the dollar versus the euro, which is what we're looking at in red. However, that all broke down in early April with all the Liberation Day stuff. So here is interest rate differential for the U.S. to Japan, and then an interest rate differential for the U.S. to Europe. We can see that for Europe, it's been basically flat, but with Japan, this peaked. The in terms of the interest rate differential, back in October of 2023, ever since then, the actual premium that you get if you're a Japanese investor for buying a U.S. government bond has actually been decreasing relative to what you would get in Japan. So the premium that you're getting in the U.S. Relative to what you can get in Japan is actually decreasing, and it's been decreasing going back to October. Now, why this matters is that Japan has run decades upon decades of current account surpluses, the exact opposite of the US. They've accumulated trillions of dollars of basically national savings, whether on the private level, the corporate level, or the sovereign level. And what this means, many people are probably familiar with Japanese ownership of, say, real estate in the West Coast. This is what they've done. They've bought in large part U.S. dollar based assets, whether it be real estate, treasuries, corporate bonds, equities, and so as the premium that you get in the US for a Japanese investor, as this continues to decrease, there is a point in time where those Japanese investors are going, well, we used to not be able to get hardly any yield in Japan, as we can see here. Rates were basically zero. But now rates are rising for mostly good reasons, and now the yield is appealing. So we're going to sell our U.S. Treasuries, take that money back home, and buy a Japanese bond that is yielding, finally giving a positive yield again. So this is why that matters. And then, of course, the U.S. relative to Europe. This has been basically range bound going back to early 2024. So here's the data. I have it as a PDF, so it's a bit easier to digest here. So just before we get into it, remember April was Liberation Day. So if you're curious about fact checking our earlier videos, look for the month of April. And then just to kind of like overview how this particular document is laid out, the blue box, this covers U.S. securities both on a gross and a net basis, and then further broken down by private investors and official government investors. Lines 14 through 18, the red box, this covers U.S. Persons foreign security transactions. So you Americans, what are Americans doing with foreign assets? Line 19 through 21 aggregate kind of long-term securities, 22 through 28 short-term securities, and then 29 through 32 in the purple box. This indicates a kind of banking flows on an international basis. So we're not going to go through every single line, just the things that we think are notable. Domestic securities, you don't want to look at gross necessarily because, again, there are sales of domestic U.S. securities, but there are also purchases. So you want to look at the net. On net for the month of June, there was a $192 billion purchase on net of U.S. securities. Once you net out the sales. Now, private, looking just at what private foreigners are doing, they only bought $3.9 billion in terms of treasury bonds. Now, if you look back and compare this to March, April, May, maybe not April, where it was deeply negative, where they were dumping treasuries, but March or May, you can see $3.9 billion is hardly anything. And if you look at equities, this is where they were coming in to really buy U.S. dollar-based assets. The foreigners were buying equities, and they were buying them. The private foreigners were buying them in mass, $116 billion. Now, if you look at official or kind of on the government side, they were selling about $9 billion of U.S. Treasuries in the month of June on a net basis. If you look at agency bonds, this is mortgage-backed securities, $3 billion in sales. If you look at corporate bonds, they bought $2.9 billion in corporate bonds. Equities on a net basis, they purchased $46 billion of equities. Look at what that was in, say, March or certainly in April, but March or May. So equity exposure is where a lot of this is coming in. They're not necessarily buying treasuries. In fact, foreign official holdings decreased by $8.9 billion. And so if you see that $46 billion in terms of equity purchases by foreign officials, and then $116 billion in terms of private equity purchases by foreigners. So it's mainly equities. They're not really buying U.S. Treasuries. Now, if you look at lines 14 through 18, again, remember this is U.S. of purchases of foreign securities. What we can see, this negative reading here on a net basis, U.S. Americans purchased $41.5 billion. As you can see here, negative entry indicates net US purchases. We can see that US individuals purchased $41 billion of foreign securities. Now, if we scroll down here, I do also think that it's important looking at short term treasuries. There's been a lot of discussion of the shift into short term treasury bills and what that indicates and that sort of thing. We can see that for the month of June, there was a $12.4 billion decrease in demand for those dollar denominated short term treasury bills. And then if we finally finish up here on kind of the banking flows, what we can see is a $60 billion reduction in terms of dollar denominated liabilities. So this could be a number of things. This could be that foreigners are kind of making a run on deposits. It could also be that more foreign loans are being, dollar denominated loans are being extended. Because remember, for a bank, if you have a deposit at your bank, that is actually the bank's liability. So if you withdraw all your money, the bank's liabilities decrease. And then also remember that as a bank, when you issue someone a loan, that is actually an asset on your balance sheet. So again, would offset a liability. So it could be that banks were either having a bit of a run on dollar denominated deposits, or that they were extending new dollar based loans. So hopefully that makes sense. That is the tick data that we find most important. Now, here's the country by country look at holdings. I put the chart here just so we can go through and look have a visual representation of each country's holdings. Japan has always been a very large purchaser of US government bonds. We can see that it has increased ever so slightly going back to the start of the year. If we move this down to the United Kingdom, who, by the way, runs a twin deficit, a current account deficit and a fiscal deficit, they are stepping in to be large buyers of US Treasuries. But they run a twin deficit. If they, for example, go through a fiscal crisis, much like they are actually, they would be forced to sell, anything to come up with the capital needed to address their fiscal issues. Right? If they are buying U.S. Treasuries and they get into a fiscal, mess, they would have to sell. By nature of running a twin deficit, they would have to sell their US dollar denominated assets. So the fact that UK has stepped up to be a large buyer is actually not that great of a sign. We can see China. China has been largely delevering from US debt. Cayman Islands, a lot of hedge funds, basically a tax haven. Again, not exactly the buyer of the debt that you would like. This has been basically flat. If you go back to, say, February, March, Canada, again, basically flat. We can see April, by the way, we were right. Canada was selling US Treasury debt in that month of April. We did look at the interest rate differential and said that that was likely going to be what appeared. Belgium has been steadily increasing their US Treasury debt, but now we're getting kind of far down the list in terms of size. Luxembourg as well, basically flat. There are also a lot of kind of tax havens and fast money sort of approach in Luxembourg, much like Ireland and Cayman Islands. Here we're looking at France. They have steadily increased their U.S. Treasury holdings, although, again, not by much. Ireland. So Ireland, fast money hedge funds. There's a lot of hedge funds and kind of fast money institutions in Ireland. We can see that they have been decreasing their U.S. Treasury holdings, again, going back all the way to kind of mid-2024. Here's Switzerland. They decreased their holdings as well, though not in April, ever so slightly in April, but mainly after that, they started to reduce their Treasury holdings. Taiwan did basically stayed flat. Singapore as well. We can see Singapore also remain basically flat going back to the start of the year. Hong Kong, now we're getting pretty far down in terms of size. Hong Kong basically flat, slight reduction going back to the start of the year. India, here we're looking at India. There was a notable decline in their U.S. Treasury holdings here towards the end of 2024. We can see that there has been a decline going back to March. And then we're getting down into some pretty small holders of U.S. Treasury debt. So why this matters is for a couple reasons. Who buys our debt matters, not the nominal number of how many foreign U.S. How many foreigners own a U.S. Treasury? That nominal number doesn't really paint the full picture. If you look at that, okay, yeah, 9 trillion. This is going up, so foreign demand is there. Well, we just went through, and a lot of the foreign demand is coming from tax havens, fast money hedge funds, or countries that run a massive twin deficit, like the UK, that could be forced to sell their U.S. Treasuries. They, by nature of running a twin deficit, you are not in good fiscal health. So this is what really matters. This is foreign held debt as a share of total US government debt. We can see that that peaked over 10 years ago. So for a decade, this has been declining. The foreign held debt, which we're looking at in white, as a share of total government debt has been declining for like 12 years. This is noted by the IMF. Here we can see falling a share of FX reserves. Here we can see non-traditional currencies. This notes, gold and RMB, the Chinese renminbi. This is further stealth erosion, they call it, of U.S. dollar share of reserves, and the red line is interest rate. Exchange rate and interest rate adjusted for the dollar weakness. This was done in, I think, 2021, or no, 2022, that the IMF put these out. But again, this trend has been in place for a long time. This goes back to 2014. Dollar share of allocated reserves on a quarterly basis has been declining. Again, this has been in place for over a decade. Here's a great chart from Gainesville Coins. And this shows the relative share that each of these instruments is holding. We can see that gold has been declining, going back to World War II era and Bretton Woods and all of that. We can see gold's share of FX reserves has been declining. But look at what has recently started to happen. So this has started to curl back up. And we also see the renminbi making a very slight increase in terms of the number of foreign central banks that are holding reserves in the renminbi. So, the dollar's reserve status, this question, to answer the question from the intro, is never going to be an overnight cataclysmic sort of thing. It's around the margins. It takes years, if not decades, for it to really play out. And the direction, if I had to guess, that this likely goes is not into, say, the yen becomes the reserve currency to replace the dollar. I think it's going to be much more of a kind of multipolar, evenly distributed sort of world. We can see gold share has been rising pretty significantly. It's doubled, basically, going back the past 10, 15 years. So gold will probably, around the margins, start to become more of a holding for current account surplus countries that have foreign exchange reserves. We can see the dollar share has been declining, again, going back to 10, 11, 12 years, depending on how you look at it. And so I think that there will be a move into maybe instead of 100% dollar allocation, we'll have, 20% dollar, 20% yen. The yen has been showing pretty significant strength since April. Maybe 20% euro, maybe a little bit renminbi and some gold, right? I don't think that there is a replacement for the dollar, but there doesn't necessarily need to be. And remember, the dollar milkshake theory and the kind of dollar squeeze where the dollar will strengthen and cause this sort of event and it'll hurt the foreigners the most. Gold has doubled over the past 2 years or so. If we go back to that TIC report, remember that dollar-denominated deposits declined by $60 billion. This is not exactly what you would expect to see in the kind of dollar milkshake sort of approach. What that presupposes is that no asset will outperform the dollar. The dollar will never show a period of significant kind of prolonged weakness, as it has, by the way, going back to the start of the year, is down about 10, 11, 12%, and that things like gold won't gradually de-lever all those euro dollar dollar denominated debts. So we've seen gold appreciate. We have seen the Swiss franc appreciate. We've seen the yen appreciate. We've seen the euro appreciate. We've seen gold appreciate, and we've seen the dollar depreciate. So the dollar milkshake theory is certainly worth consideration, and it's shaped the way that I look at things. But I think that maybe needs to be adjusted for certain outcomes that might have seemed very unlikely at the time, but appear to be playing out. So now going back to the dollar and to the S&P, during the month of June, maybe it's apparent why the S&P was showing strength then. This was back in June, and it was because foreigners were buying equities. They were not buying our debt. In fact, official foreigners were selling $9 billion of debt, but they were buying equities. So again, remember, this is a structural result of running a trade deficit or a current account deficit. The other side of that is a capital and financial account surplus. So anyways, hopefully that was helpful, and I will catch you in the next one.